The rate cut cycle is finally here. After a major cut of 50 basis points from the Fed 2 days ago, the market is reacting very positively, with Bitcoin rallying to 63K. However, I want to caution people today because FOMOing into Bitcoin right now is potentially dangerous in my eyes. We need to understand how the rate cut cycles will impact the market overall, not just Bitcoin, but also the traditional stock market, and whether there is still risk of a recession. So in today's video, I will summarize the macro events and their impact on Bitcoin, and I'll show you how I'm positioning my portfolio going into next year. Welcome back to the VirtualBacon channel. My name is Dennis. I'm a crypto angel investor for the past 6 years, and I have invested in over 100 crypto startups. On this channel, I share views on market trends and investing strategy to build wealth in crypto. Okay, so if you have any questions, please leave them down in the comments and in the chats, and we will go through them in the Q&A at the very end. Someone says audio is very low. It looks fine to me. Let me know. Okay. So let's get the facts out of the way first. So what did the Fed do this week? The Fed and Jerome Powell came out and announced that they are doing a double cut by starting with a 50 basis point cut to the interest rate target, starting from this FOMC meeting. And they have reiterated that until the end of the year, there will be at least 50 more basis points of cuts that could come in 25 and 25 in the next two meetings, or it could be paused in one and 50 basis points in the other. We don't really know. However, the market is reacting very quickly and very sharply to just this one event. So take a look at a few things here. I have a lot of charts today. First of all, here we have the S&P, and the S&P is up a lot this week, actually, from 5,400 to 5,700. For the sake of the S&P and the major indices, this is quite a big jump. And of course, for Bitcoin, we reached as high as 63,000, almost 64,000. Now, really quick, we'll get into the charts in a bit, but for now, the long-term trend of Bitcoin is still in this choppy range that we had since 6 months ago, because very clearly, we haven't broken above this higher high here. I have actually drawn these for myself, but we haven't broken above this higher high at 64,900 yet. And this is the key range to watch, essentially. Until we clear here, the market structure is still in a downtrend that we had since March. Now, that's not to say this wouldn't get broken, but this is just still too early to tell. So we'll come back to the charts in a bit, but like previously stated in my last live stream and also on our channel, I posted this community update yesterday. So many random, 4 days ago, many random media outlets were pricing in 50 basis points of a cut this week. This is bad in my opinion. No sign shows the Fed is turning overly dovish at this time. This is likely a manipulation tactic to trap investors, because going into the Fed meeting, it was basically an even split between 25 basis points and 50 basis points. Now, if it were just an even split, they could do anything they want and people wouldn't be surprised. However, going into the meeting, they really flipped the script, and most of the media came out and basically prepared people for a 50 basis point cut. And that has led to a lot of people being overly bullish for no reason, to be fair, because this 25 versus 50, both were fair. And many people were treating this as a one-time event to be, bearish on 25, bullish on 50, but really that doesn't matter. The bigger question here is, what are the impacts of the FOMC meeting minutes? What did Jerome Powell and the Fed announce that they will carry out over the next year? What are their new unemployment rate targets? How are they doing with inflation? And do they plan to cut rates very aggressively for the next year? And what are the implications of that? And does that indicate a recession or not? These are the real questions that we can answer for the long term versus this one-time event. So this is really nothing to be trading on. And that's why, first of all, I just want to caution people, just because it's a 50 basis point cut doesn't mean Bitcoin is just going to go up only from here. That's not how this works. So be very careful if that's what you think. Now, let's look at both scenarios, because even though the rate cut cycle has begun, some people are saying, oh yeah, there's the liquidity cycle that's coming. Global liquidity with M2 money supply is increasing for next year. This is my camp as well. And I do believe next year we will see a bull run in Bitcoin. However, there is also the camp of bears that treat this event as a precursor to the upcoming recession. And one of the most common charts that you have seen in this week is something like this. Is the US entering a recession? And they bring up these charts of implied federal funds rate. This is essentially what the Fed's target rate is. When they cut rates, this is what they cut. When the market expects large rate cuts over a 12-month period, as large as 2%, so 200 basis points, that usually leads to a recession after. And however, I do want to note that this is not the whole picture, because yes, recessions always come. That's how business cycles work. Expansion followed by recession. However, is the recession immediate, such that you have a rate cut and then recession immediately comes after? Or is it 6 months after? Is it 1 year after? And when you extend far out enough, recessions always appear. So what is this data point exactly? That's what we're going to get into today. And that's my kind of counter argument to the bears. So let's take a look. This is, again, very good newsletter that I recommend everyone to follow. These guys break down the market really well. And this data directly comes from Goldman Sachs. So essentially what this data tells us is, okay, we have the Fed giving us these expectations that we'll see 200 basis points of rate cuts from now until end of 2025. And usually that leads to a recession. So there's two data points there. Number one, is this accurate? Will the Fed have to cut rates? And have they announced that they will for sure cut rates by 2% over the next 12 months? There are two sides to this. First is what the market is pricing in. So we can find that out on the CME FedWatch tool. This is the most accurate tool that tells us what the expectation for rate cuts will be. And you see here, the current target rate is between 4.75% and 5% interest. And over the next year, if you look at aggregated probabilities, what most analysts are pricing in is somewhere around 2% or 200 basis points of cuts over the next 12 months until September 2025. So the market seems to think so. However, is the Fed guaranteed to do this? The answer is no. So you really have to look at what the Fed, what Jerome Powell specifically announced. So two things you can find out here. This is what the FOMC's projections are in this week's meeting on September 18th. Two very important data points here. First one is the federal funds rate, and second is the unemployment rate. So the federal funds rate have a median target of 3.4 by end of 2025. And remember, currently we are at 4.75 to 5. So that is not 200 basis points. That's 150 basis points-ish, the median level, until end of 2025. So that's even 15 months away of 150 basis points. That's quite a bit slower of cuts than 200 basis points in 12 months. That's the first data point that's important here. Second is you really have to listen to the meeting minutes from the FOMC. So you can find that out on YouTube. It's all public. I'm going to recommend you guys to watch this video from Clear Value Tax. He has a really good breakdown. Basically, there's no fluff here. There's not much opinions, just highlighting the most important things that Powell has said in FOMC this week. And one of the core things he said is that, yes, they have cut 50 basis points, a double cut, very aggressive starting. And they do intend to cut another 50 basis points until the end of the year. But that's all we know. How we get to the median target of 3.4 towards end of 2025 is not guaranteed. There is no guarantee that every meeting there will be a cut. Instead, they are going by the data. And specifically, they'll look at the dual mandate from the Fed. This is a new word I learned. Dual mandate is that, number one, is the inflation numbers. Inflation numbers are good. I think it's around 2.4, if I'm not mistaken, and their target is 2. So we're almost there. And the other mandate is the unemployment rate. And they want to keep the unemployment rate with a top of 4.4%. This is the other target that they have laid out in the FOMC projections. You see right here, unemployment rate 4.4 median by the end of 2025. So you see none of these numbers are above 4.4, which basically means unemployment rate cannot go up much further. If they go up even just a little bit to 4.5, they have to cut more aggressively. But as long as it can stay at or below 4.4, things are okay, and the Fed could cut more slowly than even these projections. That's basically what Jay Powell says. They're going to go by each FOMC meeting, look at what the unemployment rate is doing. As long as it's okay, they don't have to cut very aggressively. So that's why these projections of 200 basis point cuts from now until over the next 12 months is a little bit aggressive. It's more like 150 basis point cuts over the next 15 months, which makes this a lot more noisy, because that gives us, if you look at like 150, and 150 over 15 months is 120 basis points over 12 months. So that's not as clear of a signal anymore. Not as big as these previous times where the rate cuts were so aggressive. You have to, it would overlap with, for example, 88, 98, 96, 95, 96-ish, where there wasn't a recession. So that's the first caveat here. The rate cut, the aggressiveness of the rate cut doesn't have to be so large. This is one of the key takeaways of this FOMC. So that's first. And second is, okay, what if the Fed actually cuts very aggressive? Then what are the probabilities of a recession? Remember, why do we need to look at the recession, and what's the importance? The importance is that even though the S&P 500 and all risk-on assets are bullish, fundamentally speaking, after a rate cut cycle, because there's lower interest rates to borrow and people can invest more. However, if there is a recession, specifically within the 12 months after the rate cut cycles begin, then the S&P 500 tends to lose 15% in this period on average. This is why people are very careful now. And some people are saying, okay, if we see a recession basically happen before October 2025, then the S&P could do really bad. And this is kind of the edge case that people are saying. So is this edge case, and what's the probability of this actually happening? So if you just want the exact probability, basically there is a prediction market you can look at already, and that's, where is it? There's somewhere here, right here. You can just Google this. Probability of recession in the US from August this year until 2025. Oh, I don't know why this is blocked, but you can see this number. I had access before. The probability right now is around 61% probability to have a recession before August 2025. That's what the market thinks. Where does this data come from? You can kind of backtrack this as well. So what are the previous times that the Fed has cut interest rates in a rate cut cycle? Here are all of them. You can find this out on the Federal Reserve Federal Reserve Bank of St. Louis. And this is a really great website that has all the macro data. And basically on here, I have circled out in red all the times that rate cut cycle begun, and it was significant enough. They cut somewhere around 2% total over that period. So you see 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 times before since World War II. These are kind of the modern cuts. The previous ones, they get really out of whack. These are the usual data that people look at. Now, out of these times, how many times did we have a recession within 12 months after the rate cuts begun? Well, the recessions are actually shaded areas, as noted here. So you see these gray bars. For example, this is a recession, this is a recession. This is the short recession of 3 months we had in COVID. So out of these 13 times, how many times do we have a recession within 12 months? The answer is 8 times. So here, 1, 2, this one not, this one yes, 3, 4, 5, 6. This one in 1989 actually didn't count because the cut started in April 1989, but the recession only started in July 1990. So that was 14 months away. So this one didn't count. So 1, 2, 3, 4, 5, 6, and then 7 is 2001, 8 is 2008, and the 9th one is COVID 2020. So 8 out of 13 times we had a recession within 12 months after rate cuts. If you take 8 divided by 13, that's exactly 61% chance. So the market is very rational right now. And this is kind of the expectation we can have, which is that from now until September 2025, based on historical data, we have about 61% chance that there will be a recession. And then obviously the inverse, right? About 39, 40% chance that there won't be a recession. So that's the real data. And that's why it's not so clear cut. 60 to 40 is not like 95% chance, like people say. So some of these data out here that says here, like every time the market expected a 200 basis point of cut, every time there was a recession within several months, that's not completely accurate. It's not clear cut because we don't have to have 200 basis point cuts within 12 months. Like we said earlier, the Fed literally said they're going to go meeting by meeting. And if unemployment is okay, they don't have to cut. They can pause. And second of all is several months. What is the time period of several months? The most important is the 12 months period for the S&P to do well. And 12 months actually eliminates some of the outliers. And third is that do we include the 2000 dot-com crash, that recession, and the 2008 financial crisis and 2020? These three are also outliers. You got to consider that, right? And even if you remove these three, then you have what? 5 out of 10 times if we exclude these three. So 5 out of 10 times there were a recession. And the other 5 out of 10 times there was not a recession. So for the bears out there, yes, I agree with you. A recession eventually will come. But whether we have it in 2025 is very hard to say. Based on the past 13 times. This is the raw probability out there. So yes, I think this is the most clear data to look at actually here. So I do agree, if we see a recession, I wouldn't be surprised in 2025. But if we don't see it, that's at least 40% chance. So that's number one caveat for the bears. And a few other caveats here. when can the recession actually hit? This is also very important because remember, people take this data like this, and then they say, okay, since we have just started to rate cut and people are expecting a heavy rate cut, a recession must happen. We have said that's not true. And then second, a lot of people are trying to trade using this information and say, we for sure will have a rate cut sometime, and thus we should be short, and thus we should be, selling all of our assets. That's not smart, because let me tell you this: the rate cut, the recessions is not a leading indicator. It's a very, very lagging indicator. Because who decides the recessions? Have you ever thought about that? We all know that businesses are suffering. We know that people are getting laid off. We know the economy is bad. And if you ask anyone, people say, and I agree, we probably are in recessionary conditions. But officially, when does the recession start? What decides that? Well, if you think that there is a hard economic data signal that says we are in a recession now, that's not how it works. According to Investopedia, the rule of thumb is that 2 consecutive quarters of negative GDP growth indicates a recession. Now, we have already seen this in 2023, but the US Bureau of Economic Research said that no, we haven't entered a recession. So that's one. And two, it really doesn't matter if you think the economy is bad and if you think businesses are bad. Because what all the previous data here and how the S&P has done, based on these recession indicators, only follow one thing, which is the official announcement from the National Bureau of Economic Research, or NBER. This agency announces when the recession has occurred. And guess what? This agency is a super, super lagging indicator, and they have no requirement to make regular announcements of whether we are in a recession or not. Who decides if the US is in a recession? 8 economists that you've never heard of. And here is how this works, directly coming from the White House. How do economists determine whether the economy is in a recession? So the National Bureau of Economic Research is the official recession scorekeeper, and they just randomly announces at times that the business cycle is in an expansionary phase and the expansion has ended and then recession has started. And you can follow this. You can just Google this, and this is their website, the National Bureau of Economic Research. And here are all of their announcements. Each of these announcements, you can see here, determination of the April 2020 trough in U.S. economic activity, and determination of the February 2020 peak in U.S. economic activity. What does this mean? Whenever you have a peak in economic activity, that means the expansionary phase of the business cycle has ended. That's the peak, which means the recession starts. And whenever you have a trough, this is basically the lowest point of the economic cycle, which means the recession has ended and the expansion starts. And you see here, this is their official kind of definition of it. Right? Expansion is the normal state of the economy. Most recessions are brief. However, the time that it takes for the economy to return its previous peak, blah, blah. So on here, shaded are all the previous recessions when they happened and how long they lasted. And you see, this is the exact data that, for example, this chart uses, the shading. And when you look at this chart, that's the exact same data. Who decides it? These guys. And this is not following any specific signal. Instead, there are 8 committee members, these guys, that make announcements of when a recession has started and finished. Just Think about how crazy that is, right? But regardless, okay, if they make a good signals, sure, then we can prepare. But guess what? Look at these announcement dates. So February 2020, right after the COVID crash, right before the COVID crash, right after COVID was announced, we knew that the economy was in a recession. But they only announced that there was a recession in June 2020, 4 months after. And this isn't even that bad because it's COVID. It's very sudden. But think about, for example, 2007 and 2008. So here, December 2007 was the beginning of the last recession. And guess what? They announced that this recession started 1 year later on December 1st, 2008. What? When I read this, when I saw this, my mind was blown because this is not okay. This is not a leading indicator. This is the most lagging indicator of all. If you follow official announcements of when we are in a recession, you are 1 year late to the party. Imagine that. And in fact, I took all of these dates, okay, and then I plotted them on TradingView against all previous recessions. If I can find the thing, monthly chart, here we go. And let's take a look, okay? Really brief. So the gray shades are the actual recession periods that were announced and official, confirmed. We are in a recession then. And the red and green dates are, the reds are when they announced the recession started, and then the greens are when they announced that the recession ended. If you follow this recession news signal and use it to trade, how late would you be to the party? Let's take a look, okay? Right here, 2020, you are entering basically when the market has already recovered after recession ended. In 2008, the market started to crash December 2007. But these guys came out December 2008 and said, we're in a recession. And you see, market was basically already near the bottom. And similarly here in 2001, market was crashing, crash, and the recession officially has ended in November 2001. And then these guys come out and make an announcement and say, actually, we had a recession that started 8 months ago in December 2001. And get this, they don't even tell you that the recession has already ended. No, imagine that. Like they come out December 2001 and says, okay, we are in a recession since March 2001. And then people panic. People are like, oh wow, like that's bad. We are in a recession. We should sell. But then market bottoms, albeit kind of slowly because this is the dot-com bubble. But they only come out and say the recession has ended 2 years after, in 2003. So if you follow this type of signal, and you can scroll back right here, again, they announced the recession after it has already ended. Here, they announced the recession 7 months in. This wasn't too bad. But this one, they announced the recession 1 month before it ended. So if you follow the official news of the recession announcements, you are going to get burned. You are way behind the curve. And you cannot use the kind of recession news and kind of try to predict it and try to play the market this way. It will not work. And this is the second caveat that I had, which is the market is actually leading. Whether the market does well or not is actually leading the recession. So more often than not, if the market continues to trend up, the recession announcement never comes. It can come much, much later. And that can really skew the accuracy of this type of trade, which is like to use the recession probability as like a leading indicator. It doesn't work. It works in the exact reverse. You have to look at the stock market and how the stock market is doing in order to predict maybe 1 year out, there could be a recession announcement. And even then, you got to know that the recession announcement is usually late. Okay, so this is second, and I think this is honestly so crazy that these guys just get to decide when the recession has started. And they don't even tell us right away. Okay, so that's number 2. And number 3 is that even if you believe we will have a recession in 2025, it's still too early to tell because we have the unemployment numbers to go from. And the Fed Chair Jerome Powell actually have given us a very clear action point now over the next month, which is to follow the unemployment numbers. So remember, who decides the recessions? It's these guys at National Bureau of Economic Research. And what do they look at for recessions in order to decide, in order to justify it? They don't look at like your rate cuts or, inflation. No, they don't care about any of that. The most important thing that they look at is this, unemployment rate. Every time there was a recession, they had to announce that there was a recession. Unemployment rate had very sharp tick up. This is the most important thing. Now you can argue, like they don't even give accurate unemployment numbers. Yes, we know that. We know that they have even made revisions up, right? Unemployment is way worse than people expected. However, can they keep manipulating the data? Of course they can. And can they keep kicking the can down the road? Yes, they definitely can. So until unemployment rate really ticks up like this, they don't have to make an announcement. And that is kind of this time is different kind of argument. Am I saying this time is different? No. The recession eventually will come. But until unemployment rate right here goes up, they're not going to announce it. So whether that comes in 2025 or 2026, what really matters is the unemployment rate. So this is the real thing you need to follow. And you need to know what Jerome Powell, what the Fed says that the unemployment rate should stay at, and it shouldn't rise much higher. And if it rises much higher, then most likely the recession is just about to start. So what is that number? We have gone over it right at the beginning, and that is right here. On the FOMC economic projections, the median and the top for the unemployment rate is 4.4%. Okay? And I want to bring your attention again to this right here. So I'm going to play you guys this. Basically, this reporter asked Jerome Powell what he thinks about the unemployment rate and whether unemployment rate will rise higher or not.
Questions. You and your colleagues in your economic projections today see the unemployment rate climbing to 4.4% and staying there. Obviously, historically, when the unemployment rate climbs that much over a relatively short period of time, it doesn't typically just stop. It continues increasing. And so I wonder if you can walk us through why you see the labor market stabilizing, sort of what's the mechanism there, and what do you see as the risks?
So, again, the labor market is actually in solid condition. And our intention with our policy move today is to keep it there. You can say that about the whole economy. The U.S. economy is in good shape. It's growing at a solid pace. Inflation is coming down. The labor market is in a strong pace. We want to keep it there. That's what we're doing.
So that's that. Basically, he says unemployment rate, the top projection is 4.4%, and he doesn't see unemployment rate getting higher. Very clear, which means if that is the case, he cannot turn back on his words. Remember, this is one of the most important points. If unemployment rate even reaches 4.5%, then he has to make a change. He has to cut much more aggressively, which means all you need to look at in order to see if we'll have a very quick recession happening early 2025 versus late 2025 or 2026 is the unemployment rate. And you can follow that on any charting platform. You can go on TradingView, type in unemployment rate, and here it is. Unemployment rate right now is at 4.2%. And yes, we know that the unemployment rate doesn't just drop randomly. It doesn't drop. When it rises, it will rise. Here, not that. This one, line here. So when the unemployment rate rises, it rises. It's not going to revert randomly. And the only times that you can do and to prolong, kick the can down the road is like this, when you have the unemployment rate kind of going sideways, like here, like here, like here, or like here. This is the ideal scenario that Jay Powell wants to achieve, which is, okay, we know that we are already seeing unemployment rate rise. Let's make it top out at 4.4% max. And let's make it go sideways at least for a year or two. In that case, I can retire and not have a recession on my hands. And we kick a can down the road and we have a recession in 2026. That is his ideal goal. And so that's why I agree with you. I agree with everyone that says recession will come because unemployment rate eventually will tick up. I totally agree. But whether it will come exactly like this or it kind of goes sideways a bit and goes like this, we don't know yet, because Jay Powell has given us a lot of confidence that he basically says, okay, I'm going to do everything I can to keep it below 4.4 right here. If it does this, then, well, we're fucked. We have a recession very quickly. If we don't go above 4.4, then things are probably good. We could do something like this and then go into 2025 and then have a recession. So this is what actually matters. This is what the National Bureau of what are these guys called? Economic Research. This is the only thing that they care about, to declare an official recession. So this is what actually matters. What happens with the interest rate, et cetera, is tertiary. They can decide on the spot. They're gonna pause. They're going to cut less aggressively. They can always change that. And in fact, that has happened before. When you look at rate cut cycles, yes, sometimes they cut very aggressively, 2% over a year, 1.5% over a year, et cetera. But other times, like, right here, they have cut. For instance, in 1995, they cut from 6% to 5.2%. So 80 basis points, 75 basis points target. And then they paused it for 2 years. And similarly here, in 1984, they cut by 150 basis points, and then they paused it for a year. And here, 1966, they cut by 150 basis points, and then they paused it for 6 months. And then they started raising the rates again. So these scenarios could happen. But the only way this can happen is if unemployment rate stays below 4.4%. This is the hard line that Jay Powell has drawn in the sand. As long as unemployment rate stays below 4.4, they'll do all they can to avoid the recession and kick it down the road. So this is actually what matters. And this is the real signal that we need to look at. You can say all you want, like 2025, 2026, or right away we're gonna have a recession. But Jay Powell has a lot of cards to pull here. The only thing that he cannot go back on now is the unemployment rate. So that's why this is actually the most important thing here. Okay, so with that being said, how do we know the unemployment rate is coming up? Very clear. There are two more unemployment rate numbers. Well, it releases every month, but the next two will be very important because those are right before the elections. And if those are even bad, like, you're not gonna see better numbers in December. So these come out right here. Scheduled releases. The next one is on October 4th, and following is November 1st. And the one after that will be after the election. So in my opinion, the next two unemployment numbers will be super significant. If we can get the next two unemployment numbers to be 4.4% or lower, we're good, because that leads us into the elections, and the election uncertainty is gone. And then right after that, there's another FOMC. So Jay Powell will come out and say, look, I said we're going to make unemployment rate top out at 4.4. Looks to be good, right? And then we cut again, but he's going to be even softer and say next year, we don't have to have as aggressive rate cuts. And then that's when you'll see these rate cut expectations. And for example, on the CME Fed Watch, these guys are going to soften up as well and say, okay, the rate cuts are going to be slower, which means the economy is recovering and the recession doesn't have to come early 2025. It can be towards the end or even 2026. But the next two unemployment numbers, if they come out bad, if at any time we see 4.5, 4.6, that's going to be bad, because then November FOMC, Jay Powell has to come out and say, look, last time I said 4.4 is the top, but actually the jobs are not good. And we cut 50 more, and then, we have to cut more in 2025. And then these expectations are going to look even worse. And probably recession probabilities in 2025 will also increase. So that's why really make or break, the two numbers coming up are the unemployment numbers in October and in November, in my opinion. Okay, so a lot to go through here, but basically it's too early to tell. And while it is good immediately, and I think what's really important takeaway from this FOMC is that Jay Powell actually has given us a kind of line in the sand here on the unemployment number. But TLDR is, for the bears out there, I don't think this time is different. Okay, unlike people say, the people that reply to these like recession threads and say, oh, we won't have a recession. That's not how it works. There is always a recession. The difference is after the rate cuts begin, how long and how far away is the recession? Is it going to appear in 2025 or is it 2026? And who decides the recession and when will it get announced? And what decides that is actually the unemployment numbers. So yeah, this time is not different, but the timing is different. The timing could be different. And that's why we have to really pay attention to the unemployment numbers for the next 2 months. Okay, to summarize, that's my bear case. If unemployment numbers are bad, we are probably expecting recession in 2025. Stocks will be bad, and similarly, Bitcoin probably will be bad as well. But as long as unemployment numbers are okay, we don't have to be bad. And 2025 could see the liquidity actually prop up Bitcoin, and that's the bull case. So then let's get into the bull case, right? So what are the, really quick, what are the kind of bull cases that could happen? So I don't want to get too deep on this because I've already covered the bull case many times. You can go ahead and look at my Bitcoin cycles video and also our last video on the Bitcoin shakeout. Essentially, as long as we don't have recession and as long as the rate cuts are not so aggressive and unemployment is under control, the liquidity can then come in, because we know when there is a rate cut cycle, money printer gets turned back on and the M2 global liquidity, the M2 money supply will increase. And Bitcoin, conveniently, is the most reflexive asset when we have a increase in global liquidity. So here is Bitcoin price mapped against the M2 global money supply. And you see this is the most obvious chart that actually dictates the Bitcoin cycles. And you have seen this like over and over again. I'm not going to regurgitate. But basically, as long as we don't have a recession, this number then matters much more and can push up Bitcoin price over the next year, because this is most likely going to increase, this M2 global money supply. So that's number one. And number two is that the S&P, as long as we don't have a recession within the first 12 months, on average, the S&P does do well. Again, remember, the rate cuts are net positive for the markets. The gray here is when there is a recession within 12 months, but the blue line here is the median. And on average, as long as there's no recession, the S&P will go up, actually, 12 months after the rate cuts. And there is a, do I have that here even? Do I have that article? Yeah, not that article. I don't have that article. But the average return of the S&P 12 months after, even taking into account all rate cut cycles, is about 12 months positive. That also includes the times there is recession, which means if there isn't a recession, the S&P performs even stronger after 12 months. So when the S&P does well, Bitcoin also does well because all risk is doing well, as led by the S&P, as indicated by the S&P. So that's the bull case. As long as unemployment numbers top out, we don't cut as aggressively, there is no recession in 2025, then bull market, most likely. And does that mean recession won't come? No, but it does mean 12 to 15 months of bull market followed by potentially recession in 2026. So again, remember, the business cycles, they always come, and unemployment numbers, eventually they will take up. But we could see a scenario kind of like this, right? Where we have a year more of sideways in unemployment, followed by finally 2026, unemployment goes up. And then we have the recession. So that's not to say this time is different, but that just means it extends further. That's all it means. But still, that is a bullish case because that gives us enough time for the Bitcoin bull run to play out. Okay, so my stance right now, I think this bullish scenario is more likely, even though I have put more emphasis on today's video on what the causes and the timing for the recession and the probabilities, etc. I don't think the recessionary scenario in 2025 is the likely scenario. I think personally that we can kick the can down the road to 2026, and 2025 we have a year to a year and a half, like around 15 months of bull market period window until end of 2025. That's what I think. So that's why I still am positioned in crypto and in my portfolio, and you can see all that on the channel. And basically, I'm always bullish. But this is a rare occasion where I actually look at the opposite side and give it like full benefit of the doubt and what could actually play out here. So with all the macro being said, let's kind of zoom in a little bit and look at short to medium term Bitcoin. So Bitcoin, let me bring up the candles again here. The key level, like we mentioned at the beginning of this live stream, is right here, 65,000. The first break of market structure we need to see if this trend is going to establish itself and break much higher is right here. We need to have Bitcoin break above and close above 65,000. If this happens, essentially what we'll have is like this, where there's a higher high after this high, and that will be the first higher high we've had since March. This is the very least what we need in order to have the uptrend begin again. Until this happens, you don't want to jump the gun too early because look at what happened so far. Every time that we had a bounce, it has been lower high, lower high, lower high. And if this doesn't get above 65, it will just be yet another lower high. And see how quickly and how aggressively these lower highs have been sold off into. Every time there was a lower high, it came back down to revisit this lower trend line. So if we show a lower high here, don't be surprised if we see this. Now, am I saying this is for sure going to come? No. We are looking decent, but in order to break this lower high structure, 65 needs to be taken out. And that's the actual kind of like breakout scenario if you want to trade that. Until that happens, anything you see here really is noise. There is no signal to be traded right now. And conversely, if you're really degenerate and you want to short Bitcoin now, you could take a swing short here and then target maybe these lows here and maybe this low. You could take that. That is even more of a short-term practical trade because you have a clear stop loss above 65K. But I just don't see why people are FOMOing in right here at 64 when you could just wait a little bit and buy at 66. And that gives us so much more certainty right here. So that's why I'm not taking any trades right now. If I want to trade, especially on the upside, I will wait for this and buy on the retest. And if this gets rejected, then you could potentially buy a lot lower. That's my current stance. If we get a breakout, again, this wouldn't last much longer because you got to consider, if you are a perma bull, you have to assume that next year we're not going to have recession, which means October, November unemployment numbers have to be good. So the time, you don't even have to wait that long. This consolidation period sideways cannot last that much longer. The longest we can go until is basically second week of November. 1.5 months more, maximum. After that, there's no reason, if the fundamentals are bullish, for Bitcoin to not be broken out. So don't jump the gun right here. The finish line is almost here. You don't want to be chopped up right now. Okay, so with that being said, what's my current action? Hasn't changed. When you look at my last video, this live stream right here, my action points are the following 4. Number 1, I continue to hold spot positions heavy in Bitcoin, Ethereum, Solana. I think those 3 are going to be good no matter what. I have very strong conviction in these 3. Number 2, I don't have any leverage position right now. I think it's very foolish to take leverage right now. Spot is way safer because we could still see volatility right here, either direction. If we get a breakout like this, there's going to be a lot of people jumping the gun on this trade. And if we get a lower high, we could get another shakeout, another big scare. So either way, volatility could still play out until November-ish, when elections are over, when the next FOMC is here and the unemployment numbers are clear. So that's why I don't recommend anyone to use leverage right now. Number 3, continue to DCA on the strongest sectors that I believe in. So if you want to see that, very simple, just go to my portfolio video. I outline all of my portfolio holdings right here. Meme coins, AI coins, gaming coins, RWA coins, and some select layer 1 coins like Tong, Kaspa, Phantom. These do really well. That's basically what I continue to hold. Again, spot positions, no leverage. And number 4, just still don't over speculate. Protect your psyche. If you don't understand this macro stuff and you're not able to follow it, don't try to trade it. Just wait. Protect your psyche so that you don't lose confidence when the real bull run starts. It doesn't have to be much longer. Come November-ish, things will be, in my eyes, like completely clear because all the things will be cleared out. We're almost there. So really, really protect your psychology here. And that's it. That's all I'm doing right now. Hasn't changed. My stance on Bitcoin, pretty much the same. Continue to hold spot position, but just don't rush the gun here and don't FOMO in here. I think that's kind of dumb. Okay, that's it. And before we go, I just want to make a quick announcement. So I used to have a free Discord for trading, and you can sign up with one of our exchange partners, and it's completely free. We are revamping that to a new platform called The Coiners. And you can go ahead and follow our Twitter right now. It's linked in my bio, Coiners.io on Twitter. And this platform is our own. It's no longer on Discord. And in here, not only is it going to be me from now on doing trade setups, but also we have multiple mentors that can guide people through from complete beginner stuff. So I have recorded about 5 hours of free course that will be covering basics of crypto, trading, how to use exchanges, stop loss, take profit, trends, TA, et cetera, many different things. And these are free courses that is offered in our platform. All you need to do is the same as before, sign up with one of our exchange partners and you can access all the courses forever for free. And because we have mentorship, you can ask questions. You can ask anyone, for example, if you have a indicator you don't know how to use, we actually have a system that people can help you out. And from beginning to end, not gonna give you exact financial advice, but educational side, you can rest assured you'll find your answers. So that's called the Coiners, and we are doing our alpha launch next week. And with that, I am doing a intro workshop on the 24th, next Tuesday at 1 p.m. EST. So you can go ahead and sign up to this free event. It's going to be live stream format with me. And I will go through basically all the most important events and signals to look out for next year, why we see this bull run happening. And if I were to get into crypto right now, how would I set myself up for success? How would I trade? The platform I need to use, my trading strategies, stop loss, take profit strategies, and long-term portfolio strategies to exit the market, how I'm looking at it and how I'm preparing myself so that I don't get burnt come late 2025 when there is real recession risk, how to actually protect yourself and how to take profit, etc. So free workshop, sign up, and I'll also go through what we'll offer on the Coiners platform as well. And this is free platform. It'll be offered. We'll talk a lot more about it in the coming weeks and days with live streams and showcasing our setups, etc. So thank you guys for joining. If you like this content, be sure to subscribe to the channel, give my Twitter and my website, etc. a follow. So thank you guys, and I will see you on the next video and next live stream. Bye-bye.